It's a good morning. Hello, how are you? Hope you're doing well. Waiting to see how long it takes for this audio to confirm that you guys can hear me. All right, I hear the old man. All right, so we're going to start off with something that is driving all you crazy. The continuous contract. When do I turn on the function that's shown down here? Okay. And do this lesson one time. And if anybody ever asks about it, you're going to help the community and me greatly if you just say, go look at this video here. Okay. That way it's done, it's explained, and there's nothing for you to be worrying about or stressing me about anymore. All right. So we're only going to be focusing on this as the lecture portion. And then we're going to go into a review of the index futures market. Okay. So I'm not going to cover Forex, not going to cover dollar, I'm not going to look at gold, silver, crude oil, Bitcoin, none of that other stuff. Okay. My time's limited this morning, so I won't be able to join you in the trader roundup thing at the end. I won't even be able to hear anything. So just know that I'll have to watch or listen to it as a recording later on this evening. So if you have questions or whatever, I'll use those things to kind of like move into another live session this week, and I'll answer some of those questions if I can. So let's get this lecture out of the way because I don't want this to be long. So we have on the left-hand side, on the white background chart, you'll notice that it has June referenced there. Okay. And for the folks that say that turn up my microphone is all the way up, you need to turn your volume up. Okay. 'Cause there's nothing I can do beyond what I'm doing now. So the June rather, January, listen to me. It's a time traveler in me. Got to watch out. June delivery contract of the micro E-mini NASDAQ futures contract, or as we call it, MNQ. It's the actual delivery contract month because it has a month name in its title. But over here, it's lacking that. So that's the continuous contract. Now, predominantly, I start my analysis on the continuous contract. I'm going to cover some points as to why I do that. And then I'm going to clear up the confusion as to why I toggle sometimes on, sometimes off when it comes to continuous contract. Okay. It's very specific rules as to why I'm doing it. It's not ambiguous. It's not, you know, cherry picking for the sake of something because I'm always using the information before I give analysis. So it's pertinent. It's not guesswork. Okay. So let's first start with the continuous contract. Okay. And we're going to look at the differences because I had a question someone posted to me on X. I didn't reply there because I had every intention of covering it here. So just remember, if you're asking me something directly on X and it looks like I'm ignoring you, chances are I'm writing down that question and I'm going to segue into answering that during the speaking points of my lectures. I'm not going to sit there and say this person that it's too much time to build around all that. You'll know when your question's answered. So if we scroll over here a little bit, you'll notice that we have a high, a swing low, and a higher high. So you all know what this pattern is. This is my breaker. Okay. So when price had come back up into this area, when it returned back to this PD array, I'm looking inside of this price run as it pierced below this low. Okay, so when I'm looking back in old price data and I'm toggling on and off the adjustment for contract rollover, because that's what this is enabling you to see when you're looking at the continuous tongue twister, man. Continuous contract. You don't have this function when you're looking at this chart here. See how it goes away? You only have the option of clicking the settlement price going back to this chart here, see how it appears in the lower right-hand side? So I don't have it toggled on now, but now it is. You see it? See it has like a little gray hue around it? And this changes. See how that changes a little bit? So why am I toggling it off here? Why am I doing that? I had, excuse me, I had a student who had studied under my stuff and fell in love with my inversion fair value gap. You know him as Dodgy D or Ryan. He took it upon himself to go onto X and post a video saying, "This is the only thing I disagree about with ICT." And no, no disrespect, Ryan. Okay, I'm not trying to discourage you, but I want you to understand that the fact that you made that video is the reason why my analysis concept, using it the way I do, works. Because your assumptions is exactly what I'm targeting. You think that it's only talking about how the rollover contract feature shows the only importance of using a continuous contract, and that is not what I'm doing here. What I'm showcasing is, watch, it's not toggled on right now. That breaker, when I was looking back through price action, my eye jumps first to this. That's my breaker. By in and of itself, I want to see how that run through that low was booked. And I want to see it across different contracts and how the price action would be viewed. Look at it this way. While you're doing your analysis, if you're diligent, you're going to write down levels that you like, what you think is a key level. Retail traders write down support and resistance ideas they think is salient to whatever they're going to be trading. And those levels, they kind of like get burned into our mind. It's like a habitual ritual. We like a certain level. Okay. And if you listen to the old heads, okay, the guys that have been trading for a long, long, long time, if they're trading with one or two markets and they become a specialist, what happens is they pretty much know their levels without really thinking about it. They just like a certain level, and it's based on some kind of higher time frame area. And these higher time frame levels can be revisited several times. So the older folks that's been around the business for a long time, they can make a lot of trades around old levels because of that generic principle of looking for something on a higher time frame that they trust as a support level or a resistance level, something that gives them a cause and effect why price may or not do something. Okay. So to dispel the idea that what I'm showing is unfruitful and that you shouldn't do it, the fact that anyone disagrees with this, that's where the strength of it is. It flies in the face of everybody else's idea about it. And I got this idea when I used to be a subscriber to commodity price charts. And it was a paper chart service that was delivered to you usually on a Saturday. You'd get it delivered to your house, and you would have to create your open, high, low, and close bars by hand on the markets that you're following. And there would be months that would be the next month out, or the second month. Whereas over here, because this is the June contract, that's our front month or nearby, okay, or lead month. Usually goes by three different names, but front month or nearby, it's the one that's the most active right now. The third week of June, this will expire, and then we will roll over into the new front month or nearby. At that time, the third week of June, it'll become September delivery contract. If you're trading through TradingView and you're trading off of the continuous contract, your broker will most likely be piped into the front month, which would be the June contract over here. If you notice that both of these, they look a little similar, but not exactly. We have different price levels inside of the gradients here. If you study that versus these, slightly different, okay? Because of this breaker, when I was panning through price action, the first time when I mentioned this suspension block on the continuous contract, it was because, and I failed to mention exactly why, because they're live. and I'm not following a script. Like, I'm not following a script right now. I go by what I'm seeing, and I go by what jumps in my head to speak on. So it's not like a well planned out recorded lecture where, I have an intended goal in mind about what I want to teach. Because when we're doing the live sessions, I'm usually quickly covering over something that's led up to my expectations for the opening range of price action live. So I don't have a whole lot of time, or let me say it this way, I don't afford myself a lot of time because I want to keep these videos underneath an hour. Okay, so what I was doing was I was looking at the breaker, and then after the breaker was pierced, how did that price action book? Was it just simply one single candle going down? Did it take multiple overlapping candlesticks before it went below it? Or was it something like this? And you've learned this year, this is a suspension block. So a suspension block has a volume imbalance, which is where the bodies do not connect, but the candlesticks do overlap because of the wick. They have to at least touch or overlap each other's partially. And that looks like this. Let me get this out of the way. And I'll take this off for a second. Okay, so you can see right away there's a separation between this candlestick's closing price, this candlestick's opening price, and this candlestick's closing price, and this candlestick's opening price. So there's a little gap only seen through the relationship of the candlestick bodies. That's my volume imbalance. Okay, so let's put this stuff back together. Now, when I toggle this on, see what happens here? Watch this, Ryan. Okay. In here, there's no suspension block that agrees with what I had toggled there. And this separation, even though it has a little volume imbalance there and a volume imbalance there, watch the difference between the two. You see how this one is part of the breaker? You see that? This portion of the PD array agrees with this suspension block. This one here, it's below. There's your breaker. It's the down close candle. Not this low here. This is the breaker. So when I'm looking for that, I'm going to prefer to use the one like that. But I will have annotations on my notepad with these as well. So I'll have the volume imbalance there and volume imbalance there. And then just for the sake of knowing what those levels are as an alternative, and what would I do with that information? I would start comparing how does the price action use each one. And if we start seeing price show sensitivity around, and you can clearly see how they're using it here. I mean, look at them. The one that shows a little bit more willingness to adhere to short-term highs and lows, the bodies are laying over the levels themselves. That's what I'm looking for. Okay, so I may start out with a specific level on the continuous contract. Like, let's go back to taking it off. I may start with this one, but let's say I'm noticing that it's not really utilizing these levels that are the gradients between the high and the low of that volume imbalance, and say the other one's doing it. I will abandon this one and adopt the one that was the other one. But the context is I'm only toggling on the continuous contract. I'm only using this function here to see where those volume imbalances are. They're not to find a fair value gap that exists or not exists, and I've been consistent about this. The only time I've ever utilized this function here is when I'm looking for volume imbalances. If there's volume, like keep your eye right here. Okay, keep your eye right there. There is no volume imbalance in there. But when I toggle this, keep your eye right where I showed you. Now all of a sudden there is. See that? So when I'm looking back in price action and we're below or in close proximity to this level here, I'm going to refer to that as something that's going to be useful to me intraday. It may be a target. If I'm below it, it may draw up into that. Like it's a first level low hanging fruit objective to get to. Or in this case, it could be used as inversion here. Without toggling this on and off, many times you're not going to see a volume imbalance. Sometimes you'll have this toggled on or off like I am, but then you'll have the settlement price toggled on or off. And that's why you're not seeing the volume imbalances or the suspension blocks that I'm showing. Because if you toggle that on and off here, that's changing things too. Watch right here. See the volume imbalance right there? Right here. Keep your eye on that. If I toggle that, it goes away. And that's why yours doesn't exist. Okay. So these two settings appear on the continuous contract, but I'm already looking for something in price action to justify my research in an area to anticipate why a volume imbalance should be there or not. But it has to be wrapped around something you already know, which is a premium array here. When price goes below it, if we ever get back to it, then I'm going to utilize the one that's respecting this breaker. And let's show it to you like this. That's the high of the breaker. That's the low of the breaker. See how the volume imbalance is part of that breaker there? So that in my mind, I side with this one first, but I'm not just disregarding the other one when it's toggled on this, because now the breaker's here and there. And now some of you would look at this and say, well, this is a lot of levels. Well, think about it. If you started as a trader and you were looking for support and resistance levels, classic support and resistance levels, and you were going to trade across multiple time frames, you're not going to have just one set of a support or a resistance level. You're going to have multiple ones, right? And this is what I'm trying to get information from the continuous contract that's going to be useful to me, because this price action here, some traders are going to have this toggled on without realizing it, and they'll have an interest in trading it based on that. Others have other reasons why it's toggled on or off. A lot of traders won't even look at the continuous contract, but you're not going to be able to smooth out the gaps that exist in the contract delivery month when you're looking past where the price was clean. What does that mean? Go back over here in the regular trading out. I'm sorry, the front month or nearby contract. If we go back far enough, see how it gets spotty in here? So if you look at just this price action starting here of October last year, if you're trading this contract month like we are now as the front month, how can you trust this information here? If you're looking for something prior to that low for conceptual ideas, whether it be support or resistance, some kind of a PD array, some kind of anything, you can't trust any of this data here. So you have to look at a continuous contract like every other market analyst is doing all around the world. Even the large hedge funds, they're doing the same thing. So how are you managing that data is important. And how I do it is what I'm showcasing here. Now let's go and look at one more function about this that I think is important for you. And I think we've beat this horse to death enough, okay? If you look at where we settled on both the continuous contract on the right-hand side and then where we settled on the June delivery contract on the left-hand side, okay? Both closing prices are the same, 25,333.00. That's Illuminati. And here we have it over here too, 25,333, okay? So whenever I see that, I'm expecting them to be doing rituals over there on Jekyll Island. And I'm just kidding. I had to make sure you're paying attention. You guys are getting bored already, right? What did he say? What's he talking about? Don't worry about it. It's okay. It was sarcasm. But both of them are agreeing with the settlement price. Okay. But look what's going on. We're inside of, on the front month or June delivery contract, we're in the lower portion of that suspension block. Okay. Half gap, consequent encouragement, 25,474 half. Okay. And then the high above this inefficiency, should it keep going, that comes in at 715, say 25,715. Those are two key levels based on front month. But we have this high on continuous contract, 25,495 even. That's just above by 10 handles and a half, 10 and a half handles above consequent encouragement on the front or nearby contract. So consequent encroachment 475. We'll just call it rounded to an even number. So 475 to 495. There's 20 handles in there. Both are key levels. Why? On the front month, it's half of the suspension block. We're above the halfway point or consequent encroachment on the continuous contract. So if price is going to utilize this, all the analysts around the world looking at continuous contract, they may see this as, okay, well, here's a level that they may be targeting. Other traders may be utilizing this as a means to hold their stop loss because they're very long-term trend following. There's liquidity above that that'll draw to. And here's another caveat for the folks that like to know what they're talking about but really don't. When I'm talking about when they run the buy side here, it's not always buy side stops. Okay, what it's doing many times is triggering traders offside. So it's not just simply I'm going to stop out people that are short and have pending orders there. It's to inspire them to get long. So it's not just one primary function of the market doesn't go up here to run stops. ICT students and traders are wrong to get it wrong. No, that's a religious view. Okay. The real thing is the price runs up there to trigger many algorithms to switch sides and then start looking for price runs higher. They're attacking everyone, not just people that do manual entries or limit order entries or buy stop entries. They're trying to trip up even those that have big, large firms because they can be cannibalized too. If they can spur the interest for those algorithms to start chasing price on the upside, they've basically tricked them, basically, is what it's getting at. Okay, so when you hear these people talk about what they think is going on and how they're trying to correct me, stop. Okay, just stop. It's going to sound arrogance for a minute here, but you know what the fuck you're talking about. Okay, trust me. The fact that we have gone so far into the suspension block on the continuous contract and we are already above the consequent encroachment at 25,244 half, we're in striking distance of getting to the high of the volume imbalance of that suspension block over here. So let's play devil's advocate for a moment. Okay, say we're continuously going to go higher. We already know on the June contract we have consequent encroachment sitting at 25,474 half. That's this price level right here, where it says 0.5. That's half of this range, measured from this candlestick's close to this candlestick's open. This one sell side imbalance, buy side efficiency is bracketed with the volume imbalance at the high of it and the low of it. So you have to include that when you're doing your measurements. If you don't do that, you'll never see the beautiful perfection of utilizing these levels like this, where it shows sensitivity, where your classic support and resistance ideas fall short. So what I'm getting at here on my pad, on my little notepad, okay, I have 474 and a half rounded up by 2 ticks. So I got 475 even. Then I have the 715 level. This is like a best case scenario because it's June. But what happens if you're trying to do what I'm telling you to do as a trader right now? Look for low hanging fruit objectives. Don't demand that it traverses this much because look where we're at from 233, I'm sorry, 25,333 rather, all the way up to 715. That's a considerable run. Whereas we're here at 25,333 on continuous contract, and just to get to that high here, it's only 495. So this is where we have to measure real buying strength. Okay, not buying pressure, the ability to hold on to the maneuvering through resistance levels, premium arrays, how much energy is behind that. Because we have two test examples here, two case studies. Which one do you think is more prone to get traded to? A run of only 160 handles or so versus 400 ish. This one here is going to take a real effort to get there. Here, it's not so much. So when you're looking at trading, lowering your expectation when it's like this, that's why we want to be focusing on low hanging fruit objectives. It doesn't mean that they can't trade here or go for the relative equal highs. from this high to that high. I mean, I'm not going to be surprised once we get into May because the new Fed chair, good old boy club, he'll be in there, and you're probably going to see nothing but sugar and honey and lollipops, gumdrops, and milkshakes and sugar coma, because it's going to be constant. It's the greatest market in the world. Everything's great. Look at the stock market. That means everybody is experiencing zero inflation, where that's not true. So there's a whole lot of stuff going on in the marketplace, and by having this relationship between continuous contract and front month, I'm balancing these types of things continuously. No pun intended. So knowing what I'm looking for by toggling this function on and off here, I'm looking for where volume imbalances exist. Okay. So that's what I'm doing when I'm looking back through old price data, when it's like back here. But when I'm looking at it in relative terms to recent price action, it's the same thing. That's Nothing's changed. Okay. I'm not toggling it to find fair value gaps. I'm looking for where there may be a volume imbalance that wouldn't otherwise be seen unless I'm toggling this on or off. And the example I showed here is a perfect example of that. See that? If we were to correct and trade lower, I would view this as important, and I would have it highlighted like this. Since it gapped up based on the volume imbalance, if price were to trade down to that, I would expect the upper half of this to show discount sensitivity, keeping itself out of the lower half by the bodies, and then find something to support price to continuously move higher, especially if we don't take this high out. If it were to roll over here and go down to that area, I would be anticipating and looking for signatures in price, not just simply because it trades there, I'm going to go long, but I'd be looking for reasons to anticipate price going higher should it do that. Okay. So hopefully this is communicated with no uncertain terms why I'm using the continuous contract like I do, what I'm toggling on and off for. It's just simply to look for the volume imbalances. There's no other benefit that I use it for except for providing me data past a point where the front month or nearby contract becomes spotty. Okay. So, and also to measure the underlying strength of the market, whether we're going to continuously run higher or lower based on comparing key levels. There's a lot more room on the front month here to get to 715. And I'm not saying it's going there, but while we're moving higher each day, I'm trying to see how much of a momentum we're keeping intact in relationship to both of these. If you remember what I did earlier in the year when I was looking at the NASDAQ, um, we were looking at how the price action would trade up into these levels in here and then fold over and look for lower prices. Go back and watch the videos from February and all the live streams I was doing there. I'm actually doing both. I'm showing you the I'm not showing you June contract. I was showing you the front month contract, March, and then I was showing you the continuous contract. And some of the levels were agreeing, but others, I told you it could still go up there because the continuous contract was demanding that it goes higher versus the front month or March contract needing to go higher. And just go back and look at those lectures and you'll see what I'm showing you here is nothing different. I'm just amplifying the importance of where I'm looking and what I'm looking for when I'm toggling it on and off. Okay. Just make sure that your setting tab also, if you're looking at things and you don't have a volume imbalance or a suspension block in your charts, chances are you either have one of these two toggled wrong. If it's the continuous contract, if it's the front month contract, you probably have settlement price toggled on or off when I'm not showing mine. Okay. So that's that. Hopefully we've accomplished the method there. And if not, I apologize, but that's all I got. There's really nothing I can say to you as to what I'm doing. So here is the June contract. So we're going to roll over to MNQ. Front is not important because I want to stay within the context of the levels I've been giving you on continuous contract. So here's that same bit of business, suspension block. Okay. And secret sauce, let me get that off of there. I'm just kidding. I was measuring the lower quadrant levels with the gradients and octant levels. That's what all that was. Okay. So let's drop into a hourly chart real quick. And we'll look at what we did this week. There's a bit of business over here in price. So we had that old inefficiency back here. We worked several times in that lower half of it, and then we traded up to it one more time here. When we go into like big ranges like this, where the previous day's settlement, and then we have this huge gap, and then we have new regular trading hours opening range gaps on top of it. These levels here, they can stay open for a little while, and there's no time limit on when it can get back to them. I wish there was a way for me to say, okay, when it creates these big, huge imbalances from the previous day's settlement and then the 9:30 opening for regular trading hours, when it creates these several hundred handle openings, I always like to look for some measure of returning into it. But we have a lot of stuff going on right now, and it's very hard to cut through all of that information and disinformation because most of it's disinformation, and it's hard to trust what you're getting. And think about it like this: no matter what you're trading, whatever style of trading you're utilizing, we're all looking at the same price, and we're all having to wade through all of the stuff, all the crap. Okay, and there's a lot of people that make decisions with big money based on fundamental information. And fundamentally, everything that's coming out is BS. It's all fake. It's not trustworthy information. So that just complicates things more. And I don't have an answer for that. I'm going through this the same way you are, one day at a time, small little price runs at a time. I'm not demanding a great deal of movement. Where in the past I'm very strongly convicted to suggest this is a level I think it's going to go to. This is where I think it's going to go to. If you notice what I'm doing when I'm doing the live sessions, I'm going to just simple sell side, buy side. And I'm only leading on the opening range gap to assist me. Because if we have 70% likelihood in the first 30 minutes for it to go half gap or consequent encouragement of the regular trading hours opening range gap, if we have that much in our favor as a statistical probability, I'm going to look for the sell side if it's below us. If that consequent encouragement is below us, then it's obvious. It's a no-brainer. It's a very, very easy thing to look for sell side. If I'm looking at a market that has a discount opening range gap, that means the consequent encouragement of the opening range gap is going to be above the opening price at 9:30. So my initial bias for session, okay, for session bias, that means the first hour of trading. I'm going to be looking for price to go up to the half gap. So I'm going to be looking for what? Buy side liquidity. The draw is that simple. If you have not been doing that and you've been trying to figure out things on a whim, you're trying to just get a feel for something or you're testing other things, use what I'm showcasing because as you can see, it's perfect. It's perfect. And no one else can boast that kind of stuff. They can say, I've got good stats, I've got a good hit rate. But as a trader, it's never made sense to me to have someone tell me that they can trade with a 60% profitability or 50% profitability. Well, that's a good money manager. That's not a good trader. That's not someone that knows what they're looking for in price action and seeing it come to fruition more times than not. And it's also someone that's saying, I'm willing to lose a lot more than someone like me. I don't want to lose a lot. I don't want to do it because I know there's a skill set that's being afforded to you now that will yield to you more insight. And I'm proving it in a live stream. So there's no cherry picking about it. It's happening. So with that, let's go into a little bit of a discussion about price here. All right. So let me go back out to the daily real quick. I'm going to show you this here in a second. I have to be mindful. Let me see what time it is. I got 12 minutes. Now I got to get out of this, please. So if we look at the suspension block here, and I'm going to measure with the fib from the closing price here on this candlestick to the open of this candlestick here. So I'm dragging it from here down to there. And I'm going to toggle on so you can see this fib settings. Okay, so you can screenshot that. That's what I'm implementing. Here's your octant levels and your regular upper quadrant, consequent encroachment, lower quadrant, and all of these are octants. Okay. Now with that, like that, when we go back down to the 1 minute chart, let's go over here to the opening range. If you were watching the live stream yesterday and recall I was on the heels of having a gun pointed at me. When's the last time your mentor told you that? Most of you guys would have been hiding in your house somewhere. You wouldn't have went out here in front of everybody and still talk about what the market's going to do, right? You've been pissing your pants. So the idea of the opening range, starting with the opening price at 930, right there. Okay, so there's our opening price. So this price run up here, we were watching it live. I said I wanted to see if it can take that high out. By taking that high out, it also goes to the lower quadrant. That's what this 25 level is here. That's the lower quadrant of the daily suspension block. The full daily suspension block is shaded in gray here. All of this gray box in price action, that's what that range is. See how we're in the lower portion of it? So when price was opening here, I wanted to see it trade above that. The bodies did not breach or even stay touching that lower quadrant. That's been a key level this week or this past week, if you recall. Okay. So when we did this and we had this little gap here form, I corrected you in case you were thinking that was the first presenter fair value gap. It is a fair value gap, but what's to the left of it? The wick. So I taught you, in theory, what I said in Twitter Spaces or in passing during the lectures where I'm talking about other market moves and whatnot. Just because you see what looks like a fair value gap, if you don't know what I'm teaching in regards to how wicks are, they take precedence. The elements that create a wick, that is a gap, but it's never taught that way. Okay. And to answer the guy, I saw someone sent me a screenshot. It wasn't the person that made the post, but they were posting to somebody else making a video about me saying, I learned from Chris Laurie. For correction, okay, here's what you got to know, okay? None of the stuff you see me doing, Chris Laurie has ever done. He doesn't trade this way. He doesn't even look at the market the same way I do, okay? When I watched him teaching over at, what's it called? Forex Mentor? Forex Mentors? Forex Mentor or forexmentors.com, something like that. At the time when he first were the only thing you can see in terms of education with Forex, I said, I looked at everything over there. I bought everybody's courses back then. Everything. I bought everything. Not for the sake of learning anything, but I wanted to see what everybody's using so I can cannibalize them. I could go after them and say, okay, this is what you're using as a method. I'm going to attack that. I'm going to attack it. And I said, the only person over there that knew what they were talking about was Chris Laurie. And it was a pure price action stuff, but he still did a lot of stuff that just doesn't make any sense. So he talked about this thing called the Asian range. Okay, so I said, well, I'm going to use that and show the world what you can really do with it. I don't use the Asian range the way he taught it. I run standard deviations off of it. I can pick the high and the low of the day based on that. He wasn't ever teaching that at all. And if you've ever been a student of Chris Laurie, you'll know that's the truth, period. He deleted all of his other stuff. He got rid of all his old retail-based stuff. And that's the facts. I did not learn anything at all from Chris Laurie, except for there's a specific time of, what's it, between 5 and 6. He brought up a point where one of his students, she's a female, she liked to trade around that time. So I was like, okay, well, I'm gonna make a model that cannibalizes that. And I did. So no, I did not learn how to trade by Chris Laurie. I was trading before Chris Laurie was trading. Okay. So I don't know what to tell you folks. Okay. I understand that you want to have some kind of ammunition to come at me, but no, I did not learn from Chris Laurie. Okay. Chris Laurie paid me to go into his stuff and tell him how to improve upon the way he teaches his stuff. Okay. I have the emails to prove all that stuff. Now, if you don't like how I teach, he does a good price action based teaching. Go subscribe to him stuff, go pay for it, and you'll see that it's not what I'm teaching. Period. So there you go. There's another nod to him. He's going to get more money because I talked about him. Okay. Period. I did not learn anything from him. But I've always said in the past, he was a good person to have a baseline. It's better than support and resistance. But he abused that and then talked about me in emails, both sides of his mouth, because he had to keep a good view of himself, an image. Okay, we were supposed to do webinars together or seminars or in person. And some people said, well, I ain't going to go there because ICT is this and that. And then he said, okay, no. But he charged people that were going to go there because I was coming. So yeah, go fuck off. Okay. Who's who now? Okay. I'm the one out here live streaming telling you where the market's going to go before it happens. You don't see him doing that. Okay. You just don't see him doing it. So there's your correction there. So when we're looking at inefficiencies, if there's an inefficiency like this little gap here, this is what you see as the gap. That is not it. This is the wick. So real time, I told you, focus on that. Okay. Now, does Chris Laurie teach this? Does Wyckoff teach this? Does supply and demand teach this? Does Elliott Wave teach this? Does anything else fucking teach this? When we have a PD array or a range that we're looking at, a very specific range, price goes up and can't even accomplish getting to the high of it. You see how that wick falls short of the closing, or I'm sorry, the opening price of that candlestick right there? You see that? When it does that, that's proving heaviness. Heaviness is bearishness. It's not showing strength to continue higher. Where does the body close? It's below consequent encroachment of that wick. That is what? Heaviness. It's not bullish. Okay. So the market creates this little run here, falls off, and it attacks the sell side that I said that existed below these lows right here. Okay. For the guy over there on the Wall Street. Okay. Supposedly said that there's no liquidity sweeps. Well, I called it live, and it went down there and hit that. Then what does it do? It runs right back up to first presented fair value gap, but it's being shown to you as a wick. So stop teaching my shit and selling it because you don't know what you're talking about. This wick here, it trades right back to it again. It goes into its upper quadrant, but the bodies are now where? It can't even stay inside of that wick. Is this bullish or bearish? Bearish. Why? Because ICT, Inner Circle Trader, Michael Joe Huddleston, okay, the, the, the real McCoy told you that real order flow can be visually seen in the candlesticks. If you know what you're anchoring against, you don't have to pay for these gimmicks. You don't have to pay for some level 2 data. You don't have to pay for some software package. You don't need to look at heat maps, bubble maps, bullshit. Okay, you don't need any of that stuff. You can sit down and look at just open, high, low, and close in a candlestick and see everything that's going to happen before it does. These are footprints. This is the real fucking footprint. This is real smart money footprint. Okay. They put all these little labels on things to make you believe you're getting insider information. And here I'm out here telling you what these things are doing beforehand, just using just this. No indicators, no tricks, no gimmicks, no little software programs, nothing. Just reading price through the lens of time, then price. Once we have those two, then we can measure premium to discount, sensitivity. Can't even leave a body up here. It's burying the bodies in the lower half. That's what you want when it's bearish. It can't even leave the body up in here when it retraces back up to it. That's what you want. That's bearish. Here, trade up in here. Can it get back inside of it? Nope. Is that bullish or bearish? Bearish. Consequent encroachment of the opening range gap for regular trading hours. That was this level down here. That's what I told you I was looking for. Now, there was another level I said it could get to. It could take this, but I said it might not. But I'm confident it's going to trade here. Go back and watch the live stream. I was not calling both sides of the marketplace. Again, Millionaire Dre. There's your shout out, buddy. Every time I'm live streaming, I'm telling you where I believe the market's going to go. Okay. Your job is to look inside price action. And I asked this about when I did the Traders Roundup. I was asking for people to tell me when you were watching the live stream, what do you see for your entry mechanism? For some of you that are brand new, you don't know what that is yet. Others, by seeing me do this every day, it's starting to develop. I'm seeing this. Let's see if it happens again today. Oh, look at that. It's happening again. That's how you carve out your model. You have to put yourself in front of live price action and measure where you think it's going to go. I'm lending you my 33 years of experience. I'm lending it to you. Okay. I'm lending it to you for free. Nobody else out here is doing that for you. Okay. Every other live streamer out there, they're guessing. They are absolutely guessing. And I don't give a fuck whose name you put there. They're guessing it. I'm telling you with facts and details where it's going to go and why it should. And I'm even telling you when it's going to not do it. How's that both sides of the marketplace? Because it's not. So the longer you put this off when I'm live streaming, and if you're not using the live streams appropriately, it's not for you to take trades on. But I am not getting the feedback as the teacher. So you're looking for other things that the lessons are not intended to teach. You're skipping over everything. And you're going to be the same people that's going to be complaining, yeah, I tried ICT stuff, I tried SMC stuff, and it doesn't work. So give me an indicator. That's what you want. You want something easy. But you're not going to go around this. And I'm doing the heaviest lifting by giving you all the advantage of having 3 decades plus of experience of knowing where these things are going to go based on the logic, because I authored all this shit. If you're going to listen to me, why are you wasting it? Why are you wasting it? I would have paid my left arm to have someone first prove that this stuff works and then sit out here on live streams and tell you where the market's going to draw to. I guarantee you, it'd take me nothing more than 4 weeks. I'd have a model. I'd have a model. And I would be sitting here collecting all the information and trusting that these concepts are growing in my understanding each day. Not, I got to take another trade. I got to make some money. You're doing it wrong if you're doing that. It doesn't matter how many times I'm right. If you're doing that versus watching price and trying to let your model prove itself to you, which PD array are you looking at? If you're not doing that, you're doing it wrong. You're just hanging out ICT. And that's cool. You know, that's cool if that's all you want to do. But that's not going to make you a good trader. It's not going to make you consistently profitable. You have to have your model. I'm not going to sit out here and put you in trades. I'm not going to do that. But I will sit out here every day and tell you where the market's going to draw to. All of you have all of these concepts at your disposal. You have to find it. If I tell you I'm going to take this entry right here, you're going to ask me, what model did I use? I might be using one of 16 different models. And it may be a model that I haven't even taught yet. And then what you're going to do, you're going to send me emails. You're going to send me posts on X. You're going to leave 1,000 comments in my YouTube videos. Say, can you teach this model? Can you teach this model? Instead of just saying, it's just a PD array. It's just one more PD array applied at a time when the market was bullish or bearish at the right time of day. All of you are complicating this. I'm not. I'm giving you the freedom to decide whether you're going to be an order block trader or an inefficiency trader. Are you going to be a contrarian and look for false breakouts, climax reversal patterns where it's like a turtle soup idea where it goes above an old high and then comes right back into the range? Are you going to trade like that? Or are you going to look for continuations and range expansions? That's the easier side if you're looking for a question answered in regards to which one should a new student do. They're always easier when you're looking for continuation expansion runs to target buy side once it's already been proving it's bullish. In the beginning, you're not going to know how far above an old high the market will run to and trust that it will turn around and go back inside the range. You're not going to know that in the beginning. A lot of my students try that. They like the idea of that. And they find out they're not good contrarians. It's scary for them. And they go back to just simply looking for range expansion runs. That's easy. That's easy bread and butter, replace your job, grocery getter type of model. Over time, your experience will teach you that, oh, yeah, it's probably going to run that high, but then because it's not really underlyingly bullish, as we indicated here. Think about what I was saying during the live stream. Think about it. How many times have I told you when it was making old highs, piercing them, saying, okay, I'm going to look for it to pull back into the range. Some of you probably get uncomfortable with that. Like, I think it's going to go higher. And some of you made the mistake of trying to fade me and then sent me emails regretting it because you lost money. You're not listening. Why? Why are you trying to arm wrestle me? That's dumb. You're looking for street cred, clout, versus learning how to do this well. You can make more money doing this right versus 1 or 2 times you might get lucky because I might do this wrong one day. I might do it wrong one day and you might get the other side of that. But if you do show your face like that, I'm going to challenge you to do it every single day against me and you won't do that. So why would you even do it? That's dumb. Why waste your time doing those things? I'm not going to stop live streaming. So that way, it's going to continuously keep coming. But don't abuse the opportunity and just completely dismiss it because what you're being afforded is looking at where it's going to go with a little bit more conviction by someone who knows what they're looking for. And look at my track record doing it, live streaming. Is it going where I'm saying it's going to go? Sure. But are you able to see your entry? That's the point but that's why we're doing this. If I didn't know what I was doing, I'd be failing out here miserably. It'd be going other directions. It's not doing that. So you only need to really carve out the first 35 to 40 minutes of the day. And you can make all the money you'd ever want. And you can turn that into swing trading and position trading when the market affords you the luxuries of doing that. You don't have to stay inside of scalping. You don't have to do that. But this will afford you every aspect of trading. If you want to be a position trader, you can position yourself into the market on a key low on a day that it's not likely to continuously go higher or lower. And once you put the trade on, let it run for a while. That's a working class hero model. It's still going to use the stuff I'm teaching you here. So roll your sleeves up and just hang out with the old man and do the right things with the information. So it did draw down into these lows in here. And because there was 3 factors here. Notice the low portion of that gray box. Again, that's the lowest low of the suspension block on the daily chart. That's what we highlighted in that gray box. So we have that low, we have the CPI low, and we have relative equal lows. Well, I guess it's technically 4 things, isn't it? Because then we have consequent encroachment of the opening range gap. So see how I'm laying the cursor right over that? Look right here. Look right there. When I do that, see how it's anchored to the 930 opening price? And the rest of the levels are all toggled to regular trading hours, previous day settlement down here. So this is visually what the gap is. Half gap is here. Now, I teach you that 70% of the time, that's an enormous advantage. Think about that. What if someone said to you, I'm going to give you a method to pick the winning lottery numbers and they're going to win 70% of the time? You're quitting your job. You're quitting your job. That's what you're going to do because you have a 70% chance. If you do it long enough, you might miss a few of them, but eventually you're going to get one of them, right? Now that's an extreme example and analogy, but why are you disregarding this? Because that's your it's like the glue that holds together your first initial bias. It's built in, it's baked into the model. What model? All of them. If you don't know what that half gap level is, you're blind. If you're trading at any time during that first hour of trading, if you do not know, I said hour, not first half an hour. If you don't know what that price level is, you are absolutely guessing. And you can put whoever that is as a trader, whatever live streamer, whether they trade funded accounts, real accounts, if they have a name at a title of a firm, whatever. Bring them out here and I'll do this shit right against them and I'll pull out shit you've never seen before. I don't know why you guys are avoiding it. Come get it. I would love to entertain you motherfuckers. I would love it. because then you'd really know who the fuck I am. But that consequent encroachment level, that's your first draw. And if you have a price that's opening here and it starts to rally up like that, man, that's wonderful. That's wonderful because what that's indicating is this run is a Judas swing. It's fake. And all that's doing is opening up more potential profit, more range. When it starts here, it could open right there and go right down to consequent encroachment. Many times it does that. In fact, we saw that once this week in one candle. The first one, boom, went right up to consequent encroachment. Done. It's over. What do you do there? Well, just relax. But when you have opportunities like this, where it opens, it runs higher, you know what it's doing. It's setting up a chasing. Retail's going to want to chase that. They want to be buying a breakout. They want to chase price. Oh, it's going higher. Let me see what the CPI data. Fuck that CPI data. It's all horseshit. All of that data coming out is wasted time and energy. Don't even worry about it. What's the importance? When that report comes out at 8:30, what does it do? What does it leave in its wake? Where's the buy side and the sell side? Is there any inefficiencies that we can tackle? That's all I do with this information. I don't care what the fundamental data is because fundamentally it's bullshit. I'm technically oriented. I know that that data is going to be viewed seven different ways. And if you poll people across the internet, what they're going to see that data is being used for or not useful, you're going to get a wide disparity of all the responses. So how's that any benefit to you? You're just bringing on more bullshit to wade through. You don't need to do that stuff. You don't need to do that. So you want to reduce your focus, bring it down to things that are pertinent, something that's simple. The fewer the moving parts in your model and the things you have to refer to outside of the technicals, the better. Because at some point, you're going to see something technical, but if you put so much stock in the information that's put out in these reports, that report may sound extremely bullish. It's so bullish, it's crazy. But your technical say it's not bullish. You're going to doubt. You're going to have concern. What if I'm wrong because that's really bullish. That's really bullish. Because your infancy as a trader, brand new, you don't have the idea in here to say, okay, this is one of those instances where this is fake data. It's meant to inspire new buying at a high, and you fade it. And that's how I started doing it until I got to the point where all of my technicals speak clearer than using this information. Why even wrestle with being right or wrong about the importance of bullish or bearishness, dovish or hawkish when it comes to the fundamental data? It caused me concern. It caused me anxiety. It was one more thing to worry about. And you don't need that in trading. You need to have very few things to worry about. And by having your focus on time, when does the moves occur? I've taught that to you. They can't hide time from you. Every one of you folks listening from wherever you're at in the world, if you're wearing a wristwatch, look at it. Look at it. You have the same 12 numbers on the face of that watch that I do. If you are setting that watch to New York local time, you're on time. That's the way you see time. And the moves will occur during the times I tell you they're going to occur because it's algorithmic. It's going to run to the levels that I tell you they're going to run to because it's scripted. If you start seeing evidences that those two things are not in agreement, don't trade. Isn't that easy? But you want to wrestle with it. You want to argue with it. But yeah, but the last time I did, okay, you don't listen. Go do something else. Go learn from someone else. I don't have time to be messing around with people that are indecisive or they can't follow rules. If I see that in your responses to me on X, I don't block you. I mute you because I already know that you're going to drive me nuts. Because I've already proven in recent lectures, I've said certain things, and then you're asking me, but what about this and what about that? You didn't listen to my response or what I spoke on. I literally made it very binary. It's this or it's that. That's how I teach. It's not wishy washy. It's not ambiguous. It's not both sides of the fucking market. I'm telling you where it's going. period. Your job is to find what PD array you want to implement. Now, inside this price action, we had multiple times in here, and I knew it's a complex market. That means it's going to take a lot of experience to trade this. And I already know if I said anything more than what I said, some of you are going to chase the idea of whatever I mentioned and put some size on because you want to make money. When it's cleaner, I'll stay with the stream longer. But if it starts showing these types of things in here, everything was decoupled. The Dow was running away. The ES was just consolidating sideways, and this was the strongest one, all three. It was willing to go higher, but eventually it bent the knee to the logic I told you. Half gap, and then that electronic trading hours, back to that. Looking for it to take these lows here. It didn't quite get down to it and pulled back up into the range one more time, and eventually went higher. Now, if you take this, the lower quadrant and the next octant above it, and what I'm measuring here, I'm going to take this off just for a second so it cleans it up. This is an octant on the suspension block on the daily chart. This is the lower quadrant of it. This is the lowest octant level, and this is the low of that suspension block. Price pierced this high, this high, this high at a time when the market was bearish. It was likely to draw into its regular trading hours opening range gap. The market was decoupled. Knowing that we were looking for relative equal lows, lower than these here, and lower than that one, trading lower. This is manual intervention. They run it up, but it's not to some random level. Phil is not sitting here saying, let me just take it to, I like this number. That's not what he's doing. Okay, that's not what he's doing. The manual intervention still always goes to a level that's algorithmic. It always will do that. It will always do that. The problem is it's going to go to one that you didn't personally expect to happen right when you start watching price action. That's what makes it dangerous. And manual intervention can come out anytime. That's why you have to use a stop loss. That's why I tell you don't over leverage right now, because it's happening more often than normal. Okay, usually you might get 2 or 3 times a month in normal market conditions. Okay, normal, and many of those instances are actually scheduled. Okay, so that's around the economic calendar. We've entered a time where there's a whole lot of, I'm just going to say it. The administration's doing a whole lot of inside trading. They watched Nancy Pelosi make all kinds of fucking money, and that's why none of them voted to do anything about it, because they said, well, she's doing it, we're all doing it, fuck it. And that's what you're watching right now. Okay, that's what they're doing. Nobody's going to do anything, and before Trump gets out of there, he's going to pardon everybody. In fact, he just did it. He said he's going to do it. So it's a crime syndicate up there. Okay, the fucking mafia is running this stuff. Okay, they're in here placing heavy bets beforehand and then putting out information knowing that it's going to cause the market to have reactions. That's what's going on, folks. Like it or not, that's what it is. Okay, I look at it as it just makes it a little bit more difficult, but I'm still wanting to play the game. You may not want to. That's your decision. I'm not trying to convince you, but it's harder right now because of that. It's harder because of that. And if anybody tells you it's not, they are lying to you and they're trying to sell something to you. I promise you, I guarantee you, that's the facts. Period. Find someone that's been trading it longer than 34 years. Ask them what their opinion of the market is right now. Is this easy or is it complicated? If they're honest, they're going to tell you, we've never seen anything like it right now. And that's the truth. And just know that if you're learning how to do this in this climate, in this type of market, if you weather it and you get through it, you're going to be so much better as a trader. But it's going to be harder while you're going through it. So the choice is yours. You want to invest in yourself and dial back your expectations to realistic things? Or do you want to go out here and try to be a lottery winner, get a windfall victory? Because that ain't going to happen. Okay, I'm just going to be honest with you. It's not going to happen like that. So by measuring when prices in a large range like this, the larger the range, okay, the more opportunity you can divide and reduce the gradient levels. So an octant is an eighth, okay? You can split that between the quadrant and the octant, and half of that is what's being measured here. Did I grab it? Yeah. So I'm just going to rough eyeball it there to there. So there's the midpoint. This is event horizon. Whenever you have a wide enough range separation between a PD array, an old low, a imbalance, a gradient level, always look for that gray area in the middle. It doesn't exist in the chart. There's nothing else out there. It's like the void, okay? It's the ether, but there's something staring back at you in it. It's the event horizon. And price goes right up in there. Phil takes it right to it, books it. But now, look, what does ICT teach with real institutional order flow? If you can identify a PD array, if you're bullish, it should not touch it with the body or lay a body on it. The wick can touch it or fail to touch it. That's bullish. If it's in the upper half of it, that's discount sensitivity. That's bullish. Here, what do we see? Price wicks to it, a little bit past it. That's permissible. Where's the bodies? Not touching it. They're both below it. Is that bullish or is that bearish? Bearish. All during this time, I was ranting and raving in the Traders Roundup. So that's a little bit of regret on my part because I would have loved to be able to say, look at the price action right now. And if you listen to the rant, we were about in here. I said we're going to go down and clear out that 25,260 sell side. Those lows right here that I gave you during the live stream when we were here. And the market went down, consolidated a little bit in here, and then dumped aggressively, cleared it. Okay. So manual intervention is not going to random levels. It's still going to go to a level that you can find within real order flow with my concepts. There's going to be a PD array that's anchored right to that. In the beginning, you're not going to anticipate those things correctly because you don't know what to do with them. It'll probably be 10 years before you would be able to find a setup like this. So don't demand that you know how to do it in the first 6 weeks. Some of you are absolutely expecting to learn how to do this stuff. And that's why most people say, oh, it doesn't work because you don't know how to use it. Or you know that it's going to take you more time and you don't want to spend the time doing it because you're lazy. And I'm not going to apologize for that because it took me a lot of time to get to it too. A lot of work, a lot of effort, a lot of doing it wrong, reading it wrong. But most people, when they first start, they don't have the wherewithal. They don't have the conviction to say, I'm going to go through this come hell or high water. I know it's going to be hard. They're the same people that will join college on a free ticket scholarship. And because it's too hard, they quit. Or their parents paid for it and they still quit. That's a piece of shit. That's somebody that's not worth doing anything with. And if you think that way, you need to change the way you think. You need to be able to see this and say, this is an opportunity. I'm going to pour myself into it. Come hell or high water, I'm going to do it. And I don't care how hard it is. I'm going to get to where I want to get. And I'm not going to stop until I get there. Because you're already doing that anyway. All of you are doing that with something else. You're grinning and bearing it. You don't love doing it, but you're still pushing yourself through it. You're all working towards retirement. Either death takes you out of the game or you achieve it and you live on some kind of low income subsidy, if you even get that. But that's what all of you are subscribed to. You hate going to your job. You hate the people you work at. You hate that you don't make enough money, but you're still doing it. You're still committed to it. You work all week to get to these 2 days. And then you blow what a little bit of money you make. Why don't you take that same measure of conviction and apply it to this? And you'll probably stop doing what you're doing right now. and bring retirement closer to where you are. Just a suggestion. I mean, I don't know. Maybe some of you might listen to that. But the market trades off of this first presented fair value gap. That's the wick. Right back down to it here. Look how it uses it here, how it uses it here. Look at the bodies here. That's when it had that big dump. And then they pumped it up, cleared all the stops from here, here, and here. When this ran up here, that run on buy side tripped every algorithm to go looking for longs. And that's what happens there. They rake it across there. It's not just taking buy stops on shorts, young man. You have no idea what you're talking about, but it's fun. It's funny listening to you. The market trades down into that first presented fair value gap, which is the wick right there. But it does. It opens, trades up, and then down to the low of it and just outside of it. And then the next candle we open, let me make it a little bit bigger here. She loves that. Opens, consequent encroachment, sells off. And then what's it reaching for? Relative equal lows, sell side that doesn't ever get swept. That's a myth, right? The market doesn't do that stuff. And then trades down to 260, 25, 260, which was what I gave you as an objective earlier in the morning session. Rallies up, comes back into old order flow here. What is this? What's all this business? Small little consolidation, right? When you look at a consolidation like this and you don't see any fair value gap, what do you see? You see a wick, don't you? See this wick right there? That wick right there is the last one that was going up in price before it dove down. When we trade back up into this, this acts just like an old high. So you want to grade that. We only want the half measurement, okay? So that's consequent encroachment. We don't need the high and the low. That wick right there tells you the whole story inside this consolidation because there's no fair value gap. It's important because when price was down here, that's your premium array. So it can come all the way back up into that range to that halfway point, but it cannot breach it by body. Tell me I'm making it up as I go because that's the same shit I'm telling you all the time. It's always that. It's always that. If it were to close above that right there, that gives the allowance for continuation on the upside. Go back and look at your notes. Look at every time I've ever mentioned the wicks in deference to what we're showing you here. Look at the bodies. Can't get there. Yeah, we'll touch a little bit and then boom, run away. Your volume profile said shit, nothing about that. Supply and demand said nothing about that. No pitchforkers. Stick a fork in an ICT and twist it. That's logic that's outside of everybody else's stuff. That's real order flow. Chris Laurie's never even fucking heard of it. Okay? Done. Dusted. Period. Larry Williams never considered it. Gann never had anything to do with it. Come on. Come on. Tell me where I got this information from. Tell me where I got that logic from. Come on, tell me. Excuse me. You'll be wasting your time. But there's $5 million waiting for someone that can prove it. Well, that's never happened. The market dumps, trades outside of the low of that suspension block, trades one more time up. What's it trading to here? What's occurring here? Look to the left. Slightly higher high at a time when it should sell off. Small little separation right there. This is micro market structure. You can drill down in all this right here on a 15-second, 30-second chart, and it'll become much, much more cleaner to you. But this little separation right there, that's inversion. Carry that over. That's what the bodies are respecting there. And then it sells off. Same thing here. See that? Inversion. Look at the body staying inside of it, inside the separation right there. sells off multiple times, touching the low of the daily suspension block. Nobody else would have had that daily suspension block annotated in any of their logic or their bullshit religion in terms of technical analysis. They would not have this box or the low of that level. They would not have that highlighted. There's nothing on the daily chart that would indicate that's a reason to have a level there. But why is it doing all the things I teach? Look where it's below it here. The bodies can't even touch it now, but the wicks are being offered to it. See that? Inversion fair value gap. The bodies are telling you it's getting ready to dump. How do I know that? Look at my old recordings of my executions. When I'm writing down, I'm expecting range expansion to the downside. I want to see large ranges right now. I want to see speed and magnitude. That's the secret I'm using when I'm doing it in live executions. Trading with real fucking money, by the way. It's not always demo. It's not always demo. But I love seeing you little soy boys out there talking some shit all the time. I love it. I just push a button, you lose your mind all weekend. Sells off aggressively. Relative equal lows, tanks. Now, I said when we were here, I said the next downside is old relative, I'm sorry, old regular trading hours, opening range gap high. So if it wants to continuously sell off, we would look for that. If it would have went down there, I would have said, look, start looking for TGIF 20 to 30% of the weekly range. It could have materialized if it would have done something like this. But in here, it started consolidating, and then they sent it, after all the sideways stuff, sent it right back up into towards the daily suspension block, lower quadrant level, and then they posted it right above it. So it was kind of like a thumb in the nose, like here's your lower quadrant being pierced. But all this here is just something I would not have been able to trade on. It's just them pulling it right back off the range, low. So I covered a bit of stuff today. I realized for someone that's brand new, you want support and resistance and indicator overbought and oversold. I get that. Okay. I wasted a lot of years trying to make that stuff work for me. And if I would have learned how to read price action, like the way I teach it now, if you learn how to trade like this, you're going to see indicators suddenly start working. But nobody teaches what I teach when using indicators, and that's why their shit fails. That's why it fails. Anybody else's stuff, and this is going to be arrogance. Okay, I'm gonna talk like Elijah, and I'm building an altar right now. Okay, everybody else is wrong. If they align their analysis and what they do with what I teach, their stuff works. I challenge you, all you guys out there with your different bullshit. Okay, I challenge you. Put it against when I'm saying the market's going to do this or that. When I'm right, which is most of the time, when your shit's in agreement with it, that's why it worked. Because I said so. Because my logic said so. Because the algorithm said it was going to do that. That's it. That's the facts. And I'll leave you to wrestle with that because I could care less whether you subscribe to it or not. You can say anything you want, but you can't defeat this. You can't do it. You can't find it anywhere else. You can't find the borrowed logic. It's not rebranded anything, clowns. $5 million. Why wouldn't you come collect $5 million? You can't. He ripped off all these previous people. Who the fuck did I learn this from? $5 million, buddy. All you got to do is come out here and show where the source material I got this from. The whole internet's listening to me. Over 2 million subscribers on YouTube, and most of the people leaving comments aren't even subscribers. Look at them all in there. It's a sugar fest, isn't it? Only one or two people come in there saying some smart shit. And I try to tell you that that's the way it is. But why can't any of you find what I'm teaching anywhere else? You can't. So stop listening to these jackasses because they have no idea what they're talking about. They want you to fail like they have, or they want you to buy their bullshit. Their bullshit software program, their bullshit indicators, their bullshit gimmicks. Fuck all that. If they're rich and they can trade, they wouldn't be selling you anything. They wouldn't be selling you shit. That's the facts, Jack. There ain't no way you can slice that up. If they're selling anything, they need their grocery money. And here's good old ICT still outperforming their fucking ass for free. And you don't have to like my way of delivering it to you. You don't have to like the way I talk. I'm a sinner and I repent every single time I mess up. I do it all the time. And you're fucking up in your own life too. Difference is mine's on display. I have someone that's going to pay for my sin debt. I'm frail. I'm human. But I'm out here giving to everybody. I'm not asking for anything. You don't even have to say thank you anymore. I used to say, just be appreciative and say thank you. Fuck that. I don't need anything from you. You want to watch my stuff? Watch it. Learn from it. Do something good with it. Bless somebody else. Don't even tell me anymore. I don't even want that now. So now why am I doing it? Why am I doing it? Come on. So anyway, we went over the time a little bit. So that's kind of like usually what happens when it's going to be a short one. You fell for it again, didn't you? Damn it, ICT. You always do it. So I think this is going to be a good way to just go into the weekend. I do have another lecture. I, I don't I don't know if I'm going to be able to get it up tonight by posting it before midnight, or if it's going to be early morning hours when I wake up tomorrow. I don't know. I don't know how my schedule is going to afford that. It depends on what my wife wants to do and when she wants to do it and how long she wants to do it, and you know how that is, right? So once that works out schedule wise, I'm going to post a lecture on journaling. So if you're a brand new student of journaling, or if you heard me talk about it, what is a good way of starting and how should you collect baseline information to help you understand at least the first hour of trading? Because that's what all of you should be tackling right now. If you don't have a model, if you don't know what you're doing trade wise, if you're trying to find your model, if you're trying to learn what it is I teach, that's the best thing you can start try to do right now, is just try to build an idea on determining what goes on in that first 60 minutes of trading. So between 9:30 and 10:30, that first hour's dealing range, that's an entire universe. You can do so much with that. You can trade inside of it and never trade beyond it. You can trade inside of it and then use it for the full daily range. You can use that to get the whole weekly range when the markets are affording that type of trading. You can do one shot, one kill, where it's short term trading and hold it for a couple days. It opens the entire playing field in front of you once you understand that first 60 minutes. And in the beginning, get comfortable with knowing what it's likely to do in that first 30 minutes, because that in and of itself will put you light years ahead of everybody else, because they're trying to do more. They want more. They want bigger runs. And when they chase these bigger runs, they strike out more often. That's what I benefited from when I changed into lower time frame charts. When I was a developing student and trader, I realized the lower time frames gave me lots of opportunities. And I could be wrong intraday a few times and still make more than most people earned in a week, in a month, and sometimes in a year. If you're looking for big home run hits all the time, 500 handles, 200 handles, okay, if you're looking for that all the time and you're disregarding the opportunity to see 20 to 40 handles that are dozens of times offered to you inside of an intraday basis, it's a plethora of opportunities for you to practice. And once we get through, um, I'll probably do it in the second half of the week, probably like Wednesday, Thursday, or something like that. We'll have a live stream where I'm going to teach you how to practice entries, not for the sake of getting you into protracted runs and price action, but using fair value gaps and how to place the limit orders in there and then place the stop loss orders, like how you can go in and practice with these lower time frames and get lots of experience doing it. It's not trying to make money. You're not trying to be right, but it's to desensitize yourself, because a lot of you are reporting the same thing that existed in my trading when I first started. I was afraid to get in. I was afraid to take an entry because of what I was doing to myself when I was over trading, over leveraging, doing more trades than I should have, and really not understanding what I was doing. So if you're in that realm of your development where you feel like you know where it's going, or how you can still tape read with me when I'm doing the live streams, it'll help you facilitate the idea of watching price action. I'm not even trying to tell you to demo trade based on what I'm telling you the market's going to do. So please don't take that as an instruction or an invitation to do that, because you're going to read that as, okay, what he just said was trade my funded account, trade my account. Like, you put words in my mouth. I never said those things. Okay. But for you to use the live streams effectively, the next stage in your development is, okay, I see him calling the draw, that's been correct. So now what do we do with the information next? How do I carve out a model? How do I do that? I'll teach that stuff to you this week. I'll do it with an order block strategy, and I'll do it with a fair value gap strategy. So that way it'll help you build a baseline on what you're looking for in price action. You won't need me to make a comment about it while we're watching price. You'll see it, and then you'll test it and measure it in your own hands and say, okay, based on what he's taught, this would have either panned out or it would have lost. And you start collecting that information over the course of 6 to 8 weeks. You'll have a baseline sample set of doing one thing, collecting the information and the feedback of whether how many times it worked, how many times it failed, what was the largest drawdown when it was there before stopping you out, and what was the length of time the price ran one directional, how long it took to get to the target or the draw that I outlined each morning. So it gives you a framework, a structure, instead of just simply looking at the candlesticks and saying, I wish I knew what this is doing. Some of you understand fair value gaps. Some of you understand pools of liquidity, but you just don't know how to put it all together. So I'm going to help flesh this stuff out for you, but still give you the liberty of deciding how you're going to do it personally. But there's a big hurdle with fear, and I'm going to help you overcome that this week. Okay, we're going to go. You're going to see me putting in limit orders. You're going to see me putting in market orders, real time, with the idea of teaching you how to overcome, identifying it when it's happening in the price versus when it's looks like it's there but it's not. So that way you can see the difference. That's what jade is. You'll be able to have jade pressed in your palm this week and say, okay, this is real jade versus me giving you just any old rock that may be green. It looks like it to the average Joe, but that's not real jade. That's a skill set that has to be developed. And I'll give you the drills that you can go in your own private time, your personal time, how to practice. And these are things that you keep private. It's not about showing how many times you got it right or wrong. It's for you to get in here and desensitize yourself to, I'm afraid to take an action. I'm afraid of the outcome being adverse, and then it will deter me from wanting to keep doing it. So if I never take any action, I just stay a perpetual student of watching videos, I spare myself of doing that. That's what a lot of you are doing. And you don't even realize that's what's happening, and more time is wasted. Another year goes by, another year goes by, and you're still working. You still have a job and you're still not making money. It's not me, and it's not my concepts. It's what you're not doing or what you're doing that's incorrect. And I'm going to help you calibrate that. Okay. So until I talk to you next time, please, please, please be safe and enjoy your weekend. And I'll talk to you probably either tonight or tomorrow.